Curtis Arledge. He oversees more than $500 billion as co-head of U.S. fixed income at BlackRock. He's joining us today in special white chairs. Curtis, we're so glad to have you with us.
Thank you.
What did you make of Bernanke's comments yesterday? Essentially, rates are going to stay long, low long until we decide otherwise.
Yeah, I mean, I think that's the posture that the Fed is going to be in. I think, what people are missing, I think, is that we're all staring at economic data. It comes out at 8:30 in the morning. There's a consensus expectation. It's a little better. Oh, my gosh, the Fed's going to tighten. The Fed is also talking to the FDIC every day. They're still very in tune to what is really happening on bank balance sheets. They've watched the great engine of credit, which was the securitization market, disappear, and it really hadn't come back in any significant way yet. So we had two banking systems. We had the U.S. banking system and the shadow banking system. The shadow banking system still turned off. The Fed has replaced it somewhat with their balance sheet, but they don't lend on as aggressive terms. And so the economy doesn't have the credit that it had 2 years ago, and they know that. They're in touch with that. And so that's why tight credit still exists. We can't borrow money nearly as easily as you could 2 years ago, and it's having an impact on the labor markets because companies don't have the ability to hire as many people. Although it's getting better, it's still far from where they'd like the trends to be. So I think that's what they're really looking at, I believe.
So Fed Fund futures are pricing in a rate hike as early as June, possibly by August. You're looking at the economy, you're looking at the Fed and all those things that you just mentioned. Would you make that trade, or would you take that trade right now?
No, I don't think they're going to tighten that soon. I really do think it's going to take longer. Remember that they haven't just lowered rates; they've also been very aggressive with their own balance sheet. And I think that we're going to have a period of extended low rates because of exactly this point about the economy feeling soggy. It's going to feel better. I think a lot of the downturn that we saw post-Lehman was people going into panic mode and shutting down factories and firing workers, and now we're getting some of that back. But really being able to grow at trend, I don't think we're going to be there for a while.
Does fixed income investing right now, though, in your opinion, come down to what you think the Fed is going to do and when?
It's certainly very important because a lot of the yield curve obviously has got a lot of expectations for Fed moves built into it. And then every other fixed income market is spread against the Treasury market. I think actually in some ways that many of the credit sensitive markets like high yield, some of the non-agency mortgage markets where housing expectations are obviously important, those markets actually would do better and do better when people believe the economy is going to recover. So it isn't, I think there's some fixed income markets that won't do well if the economy is coming back and the Fed is moving, but other markets will.
And I mean, Treasury is obviously still the ultimate flight to safety, no matter what you think of how good or bad a job the U.S. government is doing right now. Speaking of which, there's a lot of people that have been on with us that have been saying, look, if you leave rates this low, we're going to create bubbles. There's going to be asset problems. There's going to be inflation. How much of a risk do you think that stands for right now?
Listen, I think there is a risk of that. I think that if we leave rates too low for too long, beyond the period at which the economy has recovered, we run the risk of creating bubbles.
Will the Fed get it right?
It's hard to say, but here's what I will say. It's amazing to me how many people are in the extremist camp. It's hyperinflation or it's second depression. I think there are some gigantic forces at work here. The Fed has the ability to observe them. They have the Fed and the global governments obviously are talking to each other in a way that they never have before.
The Fed has a credibility problem, that it's gotten a lot of big things wrong in the past.
They have.
Past 2 years.
They have gotten a lot of things wrong. I think they're hearing from more people than ever. I think they're on emergency watch still. It doesn't mean, I'm not necessarily saying it's with 100% certainty they're going to get it right, but I think the probability of them getting it right seems to be the lowest probability priced into many markets.